Welcome! In this video, Zbcn coin can increase by 80% if it completes the pattern. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When an ascending curve structure is seen in price charts, this is generally considered one of the most important technical formations that indicate the strength of the trend and the buyer's control over the market. An ascending curve actually signals that the price is moving upward with increasingly accelerating momentum over time, and that buyers are consistently overcoming selling pressure. In such structures, the price not only surpasses the previous peak with each move, but also raises the lows, which makes support levels stronger and brings resistance levels closer to being broken. When the price touches such a curve, it is usually quite normal from a technical analysis perspective for it to bounce or initiate an attack. This is because the curve acts as a dynamic support line and reinforces the confidence of market participants. The price touching this curve is actually perceived as an opportunity for buyers to take action, and often a strong buying pressure comes into play. What's important here is the psychological impact of the ascending curve. When investors see this curve, they know the market is still strongly buyer-oriented. Therefore, when the price touches this curve, the likelihood of starting a new buying wave is very high. Support taken from the ascending curve provides confidence not only technically, but also psychologically. As investors believe the price will bounce from this line and move to higher levels, they increase their buying, which strongly shifts the supply-demand balance in favor of buyers. At this point, the attack that begins when the price bounces off the curve is usually supported by strong volumes. This is because new investors entering the market don't want to miss this support level. Especially when the price touches the ascending curve multiple times and manages to bounce each time, confidence grows even more. The accumulation of this confidence sets the stage for much sharper rises in the future. The ascending curve structure also shows that the trend is healthy. For a trend to be healthy, the price must constantly gain upward momentum, and buyers must not exit the market. The bounce movement from the curve indicates the continuation of the trend. If the price can touch this curve and turn upward again without breaking down, this clearly shows that there is still strong demand in the market and the upward movement can continue. In technical analysis, such bounces are often precursors of new peaks. That is, an attack from the ascending curve can be interpreted not only as a short-term rise, but also as part of a larger trend. In such a structure, the price is likely to gain much stronger momentum in the future. This is because buyers' motivation combines with the solidity of the technical structure, encouraging continuous new capital inflows into the market. Another factor that increases the likelihood of the price making an upward move from such an ascending curve is the tendency of market participants to act collectively. Technical analysis structures are, in fact, formations seen on the screens of thousands of investors simultaneously. So thousands of investors seeing the price touch this curve are inclined to buy at the same point. This collective action can very quickly shift the supply-demand balance in favor of buyers. As a result, the price rising strongly from this point is often not a coincidence, but rather the realization of the market's common expectation. Most investors see this curve as an opportunity point, and selling pressure weakens. Following this weakening, strong buying pushes the price upward rapidly. This situation is a cycle often observed in technical analysis and has happened many times in the past. The bounce of the price when touching the ascending curve is also a behavior consistent with the nature of a trend, because by nature, ascending trends do not move in a straight line. There are corrections, small pullbacks, and pauses. However, these pullbacks are not the end of the trend, but necessary breathers for healthier continuation. touching the ascending curve is actually the most natural point of these breathers. The price touches the curve to rest, then moves upward again with new energy. For this reason, such structures in technical analysis are often considered a trend confirmation. That is, when the price touches and bounces from the curve, it actually confirms that the trend is continuing and gives confidence to investors. Another important reason why the price attacks upward from such a point is that stop-loss levels are strategically positioned around this curve. Many investors place their stop-loss orders just below this curve when buying. Therefore, when the price touches the curve but does not break downward, these orders are not triggered, and buyers relax further. This relaxation increases buying appetite. In addition, new investors also open positions when they see the price bounce off the curve. This chain effect moves the price upward faster. With volumes increasing, upward momentum strengthens, and the attack continues more powerfully. The ascending curve structure is actually a kind of confidence line. The price touching and bouncing from it reinforces investors' confidence in the market, because everyone sees the same picture: a strong trend, solid support, and rising buying demand. This combination makes it almost inevitable for the price to move to higher levels. In such a scenario, the upward potential of the price is quite high. Especially in technical analysis, such curves form the basis for long-term projections. Because as long as the price does not break this curve, the trend is considered upward. Therefore, every bounce from the curve is actually a new signal proving that the trend is continuing. In conclusion, it is very logical and positive from a technical analysis perspective to expect the price to attack upward from such an ascending curve. These structures support investor psychology, reinforce the strength of the trend, and give confidence to the market. The price bouncing upward from this point is consistent with past examples and carries a strong signal for the continuity of the future trend. As a result of such a move, the price can reach much higher levels, because the support taken from the curve forms the basis not only for short-term, but also for long-term rises. That's why an upward move from such a point should be expected and evaluated as part of the healthy structure of the trend. But we can't decide based on the curve alone, so let's look at other metrics too. Keep watching. In the RSI indicator, maintaining an upward trend is considered quite critical in technical analysis and is seen as a reassuring structure for investors. Because RSI, the Relative Strength Index, measures the strength and momentum of price movements and shows whether the price is in the overbought or oversold zone at certain levels. Therefore, following the trend structure of the RSI alongside the price provides a major advantage in seeing the market direction more clearly. Let's now examine this structure in more detail. First of all, if an upward trend is formed in the RSI, this shows us that the market's momentum is continuously gathering strength upward. In other words, even when prices make corrections, the RSI holding itself higher indicates that sellers' pressure remains limited and buyers are still strongly in play. In such a case, when the price approaches the RSI trend line or when the indicator value touches this trend line, these points act like critical support areas. Therefore, the RSI not breaking this trend is a sign that the market has not lost its momentum. If the RSI tests this trend line but does not break it, we can expect a new buying wave to follow. Because most investors follow these regions, and when the RSI approaches and bounces off the trend line, buyers step back in. To explain this with an example, let's say the RSI is fluctuating between 40 and 80 and has been in an upward trend for a long time. Each dip of the RSI forms higher than the previous one, and this pushes the trend line upward. Now, when the RSI approaches this upward trend line, for example dropping to the 50 level, instead of breaking downward, if it bounces off the line and turns upward, it sets the stage for a strong recovery in prices as well. This means that the market's healthy upward process is continuing and momentum has not been lost. On the contrary, this move can lead prices toward new highs. The RSI maintaining this upward trend actually reflects the strength of market psychology too. The flag pattern is considered one of the strongest and most reliable continuation patterns in technical analysis and is frequently followed by investors. The appearance of this pattern is generally interpreted as a sign that a strong trend will continue. The structure in question forms when, following a sharp and steep upward movement, the price moves within a narrow channel sideways or slightly downward for a certain period. During this consolidation phase, the price displays a compressed appearance similar to a flag. If the upper line of this compression area is broken upward, in technical analysis it is generally expected that the price could repeat an upward move equal to the length of the previous rally. For this reason, investors closely watch such a breakout. In the scenario you mentioned, if the price breaks above the upper line of this flag pattern, the resulting upward movement could equal the length of the pole, which corresponds to approximately an 80% rise. Since this figure points to a very high return, a successful outcome of the pattern could bring extremely positive results for investors. To further detail the logic of the flag pattern, after a sharp wave of buying that pushes prices quickly upward, the subsequent digestion of this move and profit-taking leads the price to move sideways or pull back slightly for a while. This is actually a healthy base-building process. During this period, investors, especially large funds and institutional buyers, accumulate positions again. In other words, this consolidation period can actually be seen as the preparation phase for a new rise. Because uptrends never continue vertically without pause, breaks and corrections are inevitable. The flag pattern is one of the most classic representations of such pauses. One of the most important points for the pattern to work is volume support. During the upward wave, volume is usually strong because heavy buying has entered the market. Later, during the flag consolidation, volume decreases, which shows that profit-taking is limited and there is no panic in the market. Then, at the moment of breakout, rising volume again confirms the uptrend. If the price breaks the upper band with strong volume, this gives confidence to investors and accelerates buying. Thus, the probability of achieving the target of an upward move equal to the pole length increases. The 80% potential you mentioned is therefore very important. This is not just a small rise, but a major leap that indicates a very strong trend continuation. It is also important to not overlook the psychological dimension of the flag pattern. From the perspective of investor psychology, the short pause following a sharp rise is actually a sign of confidence in the market. Because declines are usually limited and the price moves within a narrow range, this shows that sellers are not very strong while buyers are simply waiting. In other words, the bullish sentiment in the market is still dominant. This bullish mood strengthens again with the breakout and pushes the price higher. Especially the surpassing of a resistance level is considered a buy signal by many investors. At this point, both technical traders and investors who psychologically felt left behind enter the market, which increases buying pressure. When we talk about approximately 80% upside potential, it is also important to evaluate what this means in the bigger picture. Such an increase means a significant appreciation in the value of an asset. These kinds of rallies usually create new hype in the market and attract more investors, supporting the rise further. Especially on social media, in the news, and in investor communities, such breakouts begin to be talked about. This creates a chain reaction that strengthens the sustainability of the rise. In addition, since investors who trust technical analysis set target price levels in advance, the expectation of a rise equal to the pole length becomes a common psychological target in the market. This increases the probability of the price actually reaching that level. Another important detail here is that the flag pattern is usually seen in the middle of a trend. That is, this pattern does not signal the end of the trend, but its continuation. That's why investors see the flag pattern as an opportunity. If the price cannot break above the upper line and instead moves downward, this scenario may be invalidated. However, by the nature of the pattern, the probability of an upward breakout is generally higher. What investors need to do here is to be patient and wait for confirmation of the breakout, because unconfirmed moves can sometimes lead to false breakouts. But a breakout that comes with strong volume is the clearest indication that the pattern has been successfully completed. The expectation of a rise equal to the pole length allows investors to plan their strategies accordingly. For example, long positions opened after the breakout can be carried until the targeted 80% increase. Risk management is also important in this process. Stop-loss levels are usually set close to the lower line of the flag pattern. Thus, in possible negative scenarios, investors can close their positions without suffering major losses. But in the positive scenario, if the price breaks the upper line and moves upward with strong volume, investors can achieve significant gains up to the target level. If the 80% potential is realized, the overall market trend will be further strengthened. Because this is not only the target of the pattern, but also a sign that the market has gained new momentum. After such a rise, there is usually an influx of new investors, which sets the stage for prices to go even higher. This in turn creates a positive cycle in a chain reaction. In addition, the successful performance of such patterns in technical analysis increases investors' confidence and keeps market interest alive. In conclusion, if the upper line of a strong technical structure such as the flag pattern is broken, the possibility of the price rising by the length of the pole is an extremely positive scenario for investors. As you stated, this means about an 80% gain, which is a rare opportunity in the market. If the pattern works with technical, psychological, and volume support, the likelihood of this rise happening is quite high. Therefore, the formation of such a structure increases investors' hopes, gives confidence to the market, and provides a strong signal that the overall bullish trend will continue.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.